Hello everyone, Corey here with the Cyclical Investors Club YouTube channel. In this video I'm going to take you through an article I wrote a little over a week ago, or actually it's about 2 weeks ago now, on Apple and Alphabet and some of the dangers that currently exist with their stocks and why you should consider taking some profits in them or selling them if you're highly concentrated in them and you don't want to hold through potentially a big price decline. So this article's been out for a little while. I'm going to leave a link in the description. You can read it on Seeking Alpha. It was widely read and commented on, so you can go down to the comments there and participate if you want to. Since it came out, I think this is just measuring Apple's price movement. It's down about 5%. The S&P 500 is down about 2%. So we already see a little bit of this coming through where Apple's falling at twice the rate of the S&P 500. So whether it keeps up at that pace, I don't know. But really, what I want to warn everybody about in this article is what I'm calling a boom bust risk. It's easier to write than it is to say. And it has to do with stimulus money. I actually wrote this right before the Russian invasion of Ukraine. And so this doesn't have anything to do with that, basically. Although I would say that elevates overall risk. And I'll probably have a video coming out on that soon as well. So this has really more to do with two dynamics that I think are really important. The first one is the stimulus dynamic. So we got about $3.5 trillion in stimulus in the United States from the pandemic. And that a lot of that stimulus went directly to households. And my thesis here is that people spent a lot of that money on products, and that gave Apple, in the case of Apple, especially products, in the case of Google, they earned more from advertising because of the economic activity that was taking place because of the stimulus, all right? So my thesis is that stimulus is, a lot of it is ending, at least some of it has already ended. We don't know for sure what's going to happen with student loans, which I'll talk about. But there isn't really an appetite yet for more stimulus. It's possible with rising gas prices and this war that's going on that we could get some kind of more stimulus. But right now that people are worried more about inflation than they are about getting stimulus, particularly politicians. So it doesn't look like there's any more stimulus coming, and if student loans need to be repaid back soon, you'll actually have a reversal where people will not only not be getting the stimulus they were getting, but they'll actually have to pay out money that they weren't previously paying out during the pandemic. And this is going to really affect the economy. I mean, when we're talking about hundreds of billions of dollars, okay? So it's not a small amount, but you can really see it if you look at Apple and Google's, if you look at their history. And I gave you an example of Meta, which a lot of people are not going to think is comparable, but in some respects, what I show here is that this is when I first bought Meta, okay, or first wrote about buying it, which is right after I bought it, back in like a year ago, okay? And this image is from the image that I used in that article, and it shows what analysts' expectations were for the next 3 years, okay? So this is their earnings per share that the analysts expected back then for Meta. So Meta actually, if you add up the money that they actually made the first year and what they expect to make the next 2 years, it actually was more than, and I add them up here for everybody. So this is earnings per share. So in 2021, for those 3 years, they were expected to earn $40.75 combined with actual real earnings and the current expectations, they're expected to earn $41.05, okay? But the stock is down 50% from its highs, all right? So this shows you that based on earnings, and then the earnings growth is expected, this green part here with the dotted line, that's analyst expectations. So this is current. They expect their earnings after this short decline to go back to, we'll call it 15% a year, okay? So it's not like they expect that Meta to fall off, earnings to fall off forever. And what I'm trying to point out here is that the market's reaction is to this directional change, okay? This is the earnings expected for this year. Meta earned so much money in these 2 years that it surpassed expectations. Even with this decline, it's expected to surpass cumulative expectations, all right, from a year ago. And we can see that here, right? But what they didn't expect a year ago is to have any sort of interruption in those earnings growth. So cumulatively, Meta is set to earn, if analysts are correct, a little bit more money than they were expected to earn a year ago. But because the directional change here, and this is because they earned so much money in this year, earnings grew. Let me click on this, we can look at it closer. So earnings grew in 2020, 57%, and then they grew 36%. Okay, so in 2 years, we'll call it 100%. And that's partially because of stimulus money that was put into the economy. Okay, they did have some fast growth years here, but they were kind of struggling a little bit, and they earned a lot of money here. But then now we have this directional change. Now, when we have a directional change like this, it's very rare for the market to ignore it. Usually the market overreacts to the downside. Meta is an extreme example of that, okay? And I think it's down even farther since I wrote this article. So we know that the market doesn't like it when they expect earnings to go up and then for 1 year they go down. And you can lose a lot of money, or the stock of the price of the stock can fall a lot when that happens. And that's what I try to show here with Meta, even though I know that it's not exactly the same as Apple and Google. So let me go down here to understand, to give you the example from. Okay, so here's Apple. Here's Apple. It's happily going along with its little hardware cycles, basically iPhone cycles. I started this in 2013, which was when the iPhone kind of reached maturity. Like, a lot of the people that were going to get an iPhone had gotten one. And then, so that initial burst where everybody threw their Blackberries in the trash and got iPhones is over. And so this gives you a pretty well-established earnings trend for Apple for quite a long period of time. I mean, 8 years or so. And then we have the stimulus money that comes in. And almost all of it lands in, because Apple's fiscal year is in September, they have it all land pretty much in a 12-month period. And when their earnings had been, if you take it into account buybacks, their earnings had barely grown. They had almost been flat. I mean, they were going single digits during this time. And then all of a sudden they have a 71% growth year. Well, that's not anything special that Apple's doing, okay? It was stimulus money. So if you look and just kind of, I mean, I did the math and figured it out, but if you can just follow the arrow too, you can see this is about where earnings probably would have been without the stimulus money. But right now, the market expects earnings to be all the way up here. So this is a huge gap. I mean, it's incredible. So the market expects earnings to grow, and they might get close to this year because their fiscal year is in September. But I think by 2023, the odds of them growing additional, because there's no more stimulus money coming, right? It's gone. Yet they still expect them to grow even more for the next 2 years, even with, we'll just call it no more stimulus money, all right? To me, that seems unrealistic. Now, I don't necessarily expect earnings to fall all the way back down to trend, because, I mean, there's Apple has gained probably new customers, and they have more people in their ecosystem, and they have services and stuff that they're getting people to pay for. So I don't necessarily expect earnings to fall all the way back down here, but to expect them to grow for the next 2 years without more stimulus, I mean, the probability is very, very low. So we saw what happened with Meta when earnings are expected. So what happens is these will change probably. I expect by the 2023, the expectations will change, and you'll see that downward slope like we saw with Meta, and then the price will fall too. I don't have the price in here. The price is extremely high. Okay, it followed this trend. I mainly am pointing, I want people to focus on the earnings. All right, so that's a bad setup for sentiment. But and you can see that it's trading at almost a 30 PE. It's not cheap or anything. It's not like it's cheap. Now, Alphabet. I mean, this is so clear. I don't know how you could look at this and make up some other excuse other than stimulus for this sort of bump. Alphabet's going along. They had an early fast growth stage, so that a recession didn't really affect them because they were young. Now they're like a multi-trillion-dollar. I mean, I think they're over $1 trillion, probably closer to $2 trillion business. So, but we have just a clear pattern of earnings growth, and then we have a 91% year of growth. It's all stimulus money, most of it, all of it that's not in this trend. So do we expect that to keep going like analysts currently do? They're just going to build on top of that and get earn the same amount of money with no more stimulus in the economy? Well, like with Apple, it probably won't drop all the way down to trend because there's a lot more money just floating out in the economy, and it's going to get churned around, and they'll collect some of it each time it churns around through the economy. But to expect them to grow earnings again this year, even more on top of that and without any more stimulus money, I think is extremely optimistic, and this is even kind of more crazy optimistic. So we probably get something like with Meta, and this comes down a little bit, and instead of people just shrugging it off, I expect they'll sell the stock off. So I'm looking to 30 to 40% downside from the time I wrote this article, or from their peak, both for Alphabet and Apple, because the economy isn't in good shape either. So the other aspect of this is not only a stimulus probably going away, but the Fed, well, there used to be kind of a Fed put where the Fed would come in and buy things when they were down, right? I mean, they would lower interest rates when the market was down or the economy was tilting down, and now they're not going to do that. They're raising rates. So the Fed put is gone for these higher PE stocks, and there's nothing to prop these up. So I would just be really careful if I own these two. I would go read this article where I lay out everything very clearly, and then just think about your overall allocation. All right, thanks for listening, and I'll make another video soon. Bye-bye.